The stock market is getting nervous, but not for the reasons you think. It's not just about inflation. It's not just about the Federal Reserve predicting slower growth. And it's not just about Trump's tariffs shaking up the global economy. A closely watched recession indicator just started flashing red, and this one has a track record of predicting every major recession since 1955. Wall Street is watching. The Federal Reserve is watching. And you need to be paying attention too. In this video, I'll break down. Checkmark what this indicator is and why it matters. Checkmark why investors are suddenly moving their money out of the short term. Checkmark what this means for the economy, the stock market, and your investments. Checkmark and most importantly, how you can prepare and profit from what's coming next. Make sure to like this video and subscribe to stay ahead of the game. Now, let's dive in. Wall Street uses many indicators to predict recessions, but one of the most reliable is called the inverted yield curve indicator. It has successfully predicted every U.S. recession since 1955, except for 1966 and 2022. And while the 2022 signal didn't officially lead to a declared recession, the economy did shrink for 2 quarters, which is the technical definition of a recession. And guess what? This indicator just flashed again. So, what does this actually mean? Why is it so important? Let's break it down. Think of it like this: when you invest your money, you have a lot of options. Checkmark stock, checkmark real estate, checkmark crypto, checkmark gold, checkmark bonds. One of the safest ways to invest is through bonds. Small diamond: a bond is basically a loan. You lend your money to a company or the US government, and they pay you interest in return. Small diamond: when you lend money to the US government, it's called a treasury. There are 3 types of treasuries based on how long you lend your money. Checkmark treasury bonds 20-30 years, checkmark treasury notes 2-10 years, checkmark treasury bills less than 1 year. Normally, the longer you lend your money, the higher the interest rate should be. Why? Because if you're tying up your cash for 10+ years, you expect a bigger reward for the risk. But here's where things get scary. Right now, short-term interest rates are higher than long-term rates. This means investors are so worried about the short-term economy that they're moving their money into long-term investments instead of keeping it in the short term. This is called an inverted yield curve, and it's a major red flag. So why are investors moving money out of short-term bonds and into long-term bonds? Keycap 1: the Federal Reserve predicts a slowdown in the economy. Keycap 2: the Trump tariffs are making businesses nervous. Keycap 3: inflation is still a major concern. Keycap 4: investors don't trust the short-term stock market. Uncertainty kills short-term investments. If you're an investor and you see uncertainty ahead, you're going to try to lock in your money somewhere safe, like long-term treasuries. And this shift in investor behavior is what's causing the inverted yield curve. Let's be clear, just because the yield curve is inverted does not mean we are guaranteed to have a recession. But history shows that this indicator has been accurate for decades. We've had 16 recessions in the last 100 years. That's more than 1 per decade. The longest period we've gone without a recession was between 2008 and 2020. The key takeaway? A recession is not a question of if, it's a question of when. So the real question is, how do you prepare? Here's what smart investors are doing right now. Keycap 1: stay diversified, don't have all your money in just one asset class. Consider stocks, real estate, gold, and even cash reserves for buying opportunities. Keycap 2: keep buying, but be strategic. This is why Warren Buffett says, time in the market beats timing the market. You don't need to perfectly predict when a crash will happen. You just need to keep buying smartly. Keycap 3: look for market shifts. Certain industries could thrive in a downturn. Gold and precious metals, safe havens. Dividend stocks. Stable income during volatility, U.S. based manufacturers. If tariffs bring jobs back to the U.S., Wall Street doesn't panic, it adapts. And if you want to build wealth, you need to do the same. Let's talk about what not to do. Keycap 1: don't panic. Selling in a downturn locks in your losses. Keycap 2: don't try to time the market. Nobody knows exactly when a crash will happen. Focus on long-term strategy. Keycap 3. Don't ignore what's happening, stay informed. Be proactive. The worst thing you can do is pretend everything is fine. This is why I created Market Briefs, a free daily newsletter to keep you updated without the noise. Sign up in the description below. The inverted yield curve is flashing a warning. The economy is showing signs of slowing down. The stock market is getting nervous. So now is the time to get serious about your investments. Join my free investment workshop on March 11th, where I'll be breaking down. Checkmark how these changes are creating new investment opportunities. Checkmark what assets could boom during the next recession. Checkmark how to position yourself to come out ahead. Spots are filling up fast, so hit the link in the description now to reserve your seat. Don't forget to like this video and subscribe for more updates. Drop a comment below. Do you think a recession is coming? Let's talk about it.